I'm Alan Kinney, Editorial Director with REIT.com, and we're at the Wynn Las Vegas for REITWorld 2015, NAREIT's annual convention for all things REIT. I'm joined by Bruce Schanzer, President and CEO of Cedar Realty Trust. Bruce, give us an update on how things are progressing with your capital migration strategy.
Thanks for asking. Things are going very well. As I mentioned on our most recent earnings call, on our third quarter 2015 earnings call, we have 2 assets under contract in Washington, D.C., both grocery anchored. The total cost is $60 million. So for the year, that will take us over $100 million, which is our target, was to try and be around the $100 to $150 million. On the divestiture side, so as you may recall, the way we've been doing our capital migration is buying assets and then paying for those assets by selling assets. We have 1 asset under contract and another asset that is being actively marketed and that's pretty close to being under contract. That will be more than sufficient to pay for these 2 assets. And in fact, what's interesting is that based on just the market tone right now, what we're doing is actually going to be generating excess proceeds. So we're going to be selling a little bit more from a dollar value perspective than we're buying, with the thought that we'll have some cash available to potentially take advantage of opportunities that we're looking at. And to the extent that there's an interest rate increase, like people are talking about, and cap rates move a little bit, we'll be well positioned to take advantage of potentially improved buying opportunities as we come into next year.
And in this kind of operating environment, what kind of leeway do you feel like you have to raise rents and try to boost occupancy also?
So as I'm sure you're hearing when you speak with folks, and it certainly is the chatter in the market about the supply-demand disequilibrium, the fact that there's quite a bit of tenant demand and that there's not very much new shopping center supply. We're certainly seeing that. On a Cedar specific level, there really are 2 major themes, I would say. One is we've been focusing on annual rent bumps a little bit more, and so both on our renewals as well as on our new leases, you're seeing more of that, and that's certainly something we talked about on our most recent earnings call. Getting even more deep into our portfolio, we have 4 large box vacancies that came along at an average base rent of about $8. Those are for various reasons. Tenant move-outs. In one instance, it was the A&P bankruptcy. In all instances, we have an opportunity to push rents, and we think that's going to be, although in the near term, a slight uptick in vacancy as we fill those boxes. We expect to see a nice pickup in rents, and so I think that there are a couple of places where we could potentially see improvements as we come into 2016.
Bruce, let's talk about Cedar Realty's tenants. What are some of the dominant trends you're seeing there, and how's the company reacting?
So as a predominantly grocery-anchored shopping center REIT, most of the co-tenants with our grocers are in the business of trying to attract the local customers who are looking to satisfy day-to-day needs. We are seeing a slight trend in terms of an increase in medical use, so fast in and out type doctor visits. We're also seeing an increase in fitness clubs and wellness facilities, whether it's massage, like Massage Envy, or health club operators. We're also seeing an increase in beauty. We're seeing an increase in pet. And so those are all areas where we're seeing increases. Of course, there's been a general uptick in experiential uses. So we actually put a jumping place where kids can go, in these trampoline type places in one of our centers, and we're seeing an increase in restaurants and fast casual. So a little bit of an uptick in experiential uses. In terms of other trends that we're seeing, we are seeing an uptick in pad development in our centers, which is great. We have incredibly high returns on investment on those types of capital allocations, and so that certainly has been a terrific trend. We're seeing a little bit of an increase in a desire by some of our larger tenants, not necessarily over 15,000, but sort of close to that 15,000 square foot type tenant, such as a Staples, let's say, to on the margin take down some of their space and reduce their footprints a little bit. We actually find that to be a positive in terms of the ability to subdivide that space and re-tenant it to tenants that want to pay more rent or that are willing to pay more rent. And so on the margin, we see things going well for Cedar in terms of addressing new tenant trends and being able to capitalize on them to drive higher rents and occupancy.
Well, thank you so much for your time, Bruce.
Thanks, Alan.
For more from REITWorld 2015, check out REIT.com.